It is 8:17 p.m. in suburban Ohio, and a 36-year-old father of two is sitting at his kitchen table looking at a life insurance bill he barely remembers signing up for. 15 years ago, it felt responsible. He had just gotten married, bought a house, and his first child was on the way. A life insurance policy sounded like one of those adult decisions that meant he was doing life correctly. Protect your family, lock it in, be responsible. That was the pitch. And like millions of Americans, he signed without asking the question that actually matters. Not what does this cost per month, what does this cost over time? Because in America, that is how most expensive financial decisions hide. They are not sold as total cost, they're sold as manageable monthly comfort. $40 a month sounds responsible, $120 sounds affordable. $200 sounds normal if it protects your family. But over 15 years, those numbers become something very different. They become thousands of dollars most people never stop to measure, often paid into policies they do not fully understand, do not optimize, and in many cases no longer even need in the same form. That is the real cost of life insurance in America. It is not just what leaves your account each month, it's what that money could have become, what kind of policy it was placed into, and whether it was solving protection or quietly becoming a financial drag disguised as responsibility. This is where life insurance becomes less about safety and more about financial psychology, because most Americans do not buy life insurance based on math, they buy it based on fear. Guilt and identity, fear of leaving family exposed, guilt about being unprepared, identity tied to being responsible. That emotional framing is powerful, and insurance companies understand it better than most consumers do. That is why so many people buy coverage emotionally, fund it passively, and review it almost never. And over 15 years, that turns a well-intentioned financial decision into one of the most misunderstood costs in the average American household. Before we break down what life insurance really costs over 15 years, what most people overpay for, and what actually makes sense, hit like, subscribe, and follow Dollar Neck, because this channel is built for people who want to understand what money is really doing behind the monthly payment. Life insurance is not just about protection, it's about whether the price of peace of mind is building security or quietly draining it.
The real cost of life insurance over 15 years is not just the premium, it is the total opportunity cost of where that money went and what it could have done instead. This is the part most Americans never calculate. A 34-year-old couple in North Carolina, each paying $95 a month for life insurance, might think they are spending a manageable $190 that feels small enough to ignore. But over 15 years, that becomes more than $34,000 before rate increases, riders, or policy adjustments. And that number alone changes the conversation, because now the question is no longer, can we afford this monthly payment? The question becomes, what exactly did this money buy us over a decade and a half? That is where the real divide begins. If the answer is pure protection during the years your family needed it most, then that money likely did its job. But if the answer is a bloated permanent policy sold as an investment, a cash value product with high fees, or coverage you kept paying for long after your risk profile changed, then the cost becomes much harder to justify. This is where life insurance gets expensive in ways most people never notice. Not always because premiums are outrageous, but because policies are often mismatched, overbuilt, or emotionally sold far beyond what was actually needed. A young family usually needs income replacement, not a complex wealth product. But many Americans are sold permanent coverage long before they need estate planning tools, simply because the commission is higher and the product sounds sophisticated. That difference matters. A term policy and a permanent policy can both be called life insurance, but over 15 years they can produce radically different financial outcomes. One protects efficiently. The other often mixes insurance with expensive financial engineering most households never fully benefit from. That is the hidden cost: complexity, fees, misalignment. Most people do not overpay because they wanted to. They overpay because insurance is one of the few financial products people buy emotionally and then leave unexamined for years. And the longer it goes unreviewed, the more expensive that passivity becomes. Life insurance can be one of the smartest financial tools in America. It can also become one of the quietest long-term drags in a household if nobody ever stops to ask whether the policy still fits the life it was meant to protect.
What makes life insurance expensive over 15 years is not just buying the wrong policy. It is keeping the wrong policy for too long because nobody revisits the original reason it was bought. That is where cost quietly turns into waste. Most Americans buy life insurance during a specific life stage: marriage, kids, a mortgage, new financial responsibility. And at that moment, the logic is often valid. Someone depends on your income, and replacing that income matters. But 15 years later, the financial picture is rarely the same. Income changes, savings grow, debt falls, kids get older, risk shifts. Yet millions of Americans keep paying for the exact same policy with the exact same assumptions long after the original need has changed. That is where the drag begins. A 39-year-old father in Arizona may have needed heavy coverage when his children were toddlers and his savings were minimal. By 54, his mortgage is smaller, his retirement is stronger, and his children are closer to financial independence. The risk did not disappear, but the structure of it changed. If the policy never changed with it, the cost may no longer match the purpose. This is one of the most common and least discussed leaks in household finance. People review streaming subscriptions more often than insurance policies that have been pulling money for a decade. And because life insurance is emotionally framed as protection, many people are afraid to question it. Canceling, reducing, or restructuring coverage can feel irresponsible, even when it is financially rational. That is the psychology insurers benefit from most. People do not want to feel exposed, so they keep paying for certainty they may no longer need in the same form. But good financial protection is not about keeping every policy forever. It's about matching coverage to actual risk. That means reviewing beneficiaries, policy type, coverage amount, term length, and whether the original purpose still exists. Insurance should evolve as your life evolves. Otherwise, protection becomes inertia, and inertia is expensive. Over 15 years, the real cost of life insurance is often less about the product itself and more about the silence around it. The policy gets filed away, auto-paid, and emotionally protected from scrutiny while your financial life changes around it. That is how something designed to create security slowly becomes a cost nobody questions enough.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.